Welcome to Candlestick Chart Patterns, the complete visual trading guide from Hollow Point Trading. This video will cover over 18 patterns, including reversal and continuation signals. Here is our table of contents. We'll start with the fundamentals of candlesticks, then examine single, dual, and triple candle patterns. Finally, we'll wrap up by putting it all together in a trading context. Candlestick charts originated in 18th century Japan. Each candle represents a single time period, showing the open, high, low, and close prices. The body shows the open to close range, and the wicks show the high and low extremes. Understanding the candle's anatomy is crucial. The highest point is the high, and the lowest is the low. The real body shows the open and close price. For a bearish candle, the open is at the top of the body, and the close is at the bottom. The color and direction of the body indicate who won the period. Bullish, or green, candles close above the open, showing buyers controlled the period. Bearish, or red, candles close below the open, signaling sellers controlled the period. The Doji is an indecision candle, where the open and close are virtually the same. It is a neutral or reversal signal with moderate reliability. There are different types like standard, long leg, Dragonfly, and Gravestone Doji. The Doji's meaning depends on its context. After an uptrend, it suggests a potential reversal down, as buyers lose momentum. After a downtrend, it signals a potential reversal up, indicating sellers are exhausting. The hammer is a bullish reversal pattern, with a small body at the top and a long lower wick. It must appear at the bottom of a downtrend to be valid. The wick should be at least twice the body length. The hammer and hanging man have the same shape but opposite meanings, determined by the trend context. A hammer is bullish at lows, showing buyers rejected lower prices. A hanging man is bearish at highs, indicating sellers emerged at the top of an uptrend. The inverted hammer is a potential bullish reversal, featuring a small body at the bottom and a long upper wick. It appears at the bottom of a downtrend, suggesting buyers are returning, though it requires confirmation. The shooting star is a bearish reversal pattern found at the top of uptrends, characterized by a small body at the bottom and a long upper wick. It indicates that sellers overwhelmed buyers and is very effective at key resistance levels. The Marubozu is a strong trend candle with no wicks, meaning the open or close are at the extreme high or low. The longer the body, the stronger the conviction. They often act as support or resistance on retracements. Marubozu variations like the opening and closing Marubozu have one wick missing, still indicating a strong directional bias. A closing Marubozu is generally considered stronger because momentum carried right into the close. The spinning top signals indecision, with a small body and long upper and lower wicks of roughly equal length. It is a warning, not a signal, and is best used with confluence like key levels or volume divergence. The key difference between a spinning top and a doji is the real body size. Spinning tops have a small but visible body and show slight directional bias. Doji have virtually identical open and close prices, showing complete equilibrium and a stronger indecision signal. Moving to dual candle patterns, the bullish engulfing is a strong bullish reversal. A large green candle completely engulfs the prior red candle's body, ideally appearing at support after a downtrend. The bearish engulfing pattern is the opposite. A large red candle completely engulfs the prior green candle's body at the top of an uptrend. This is a strong bearish reversal, most effective at resistance. The bullish Harami is a reversal warning, less reliable than engulfing. It involves a small bullish candle contained within the body of a larger prior bearish candle. Always wait for a third candle confirmation for a long entry. The bearish Harami is the inverse pattern, consisting of a small bearish candle within a larger bullish candle's body at the top of an uptrend. It shows buying momentum fading and requires bearish confirmation below the mother candle's open. The tweezer bottom is a bullish reversal marked by two consecutive candles with matching lows, confirming a double rejection of a price level. The ideal pattern is a bearish candle followed by a bullish one, reinforcing a support zone. The tweezer top is a bearish reversal showing two candles with matching highs at the top of an uptrend. This pattern signals a double rejection of resistance, and higher time frames generally produce more reliable signals. The piercing line is a bullish reversal. The second green candle opens below the first red candle's close and closes above the red candle's midpoint. Deeper penetration past the 50% mark yields a stronger signal. The dark cloud cover is the bearish version, appearing at the top of an uptrend. The second red candle opens above the first green candle's close and closes below the green candle's midpoint. Volume confirmation strengthens the signal. The morning star is a highly reliable three-candle bullish reversal pattern. It consists of a large bearish candle, a small indecision candle, and a large bullish candle closing into or above the first candle's body. The small candle's color is irrelevant. The evening star is the bearish mirror of the morning star, signaling the end of an uptrend. It is formed by a large bullish candle, followed by a small star candle, and finally, a large bearish candle closing into or below the first candle's body. The three white soldiers is a high-reliability bullish continuation pattern. 3 consecutive long bullish candles open within the prior body and close progressively higher, often appearing after a downtrend or consolidation. The 3 black crows is the bearish equivalent, indicating a high-reliability continuation of selling pressure. 3 consecutive long bearish candles open within the prior body and close progressively lower. Look for this pattern at resistance. The 3 inside up is a confirmed bullish reversal pattern combining a Harami with a strong confirmation candle. The third bullish candle closes above the first candle's open, adding much higher reliability than a Harami alone. The 3 inside down is a confirmed bearish reversal. It starts with a Harami pattern, followed by a large bearish confirmation candle that closes below the first candle's open. This pattern is best traded at key resistance zones. The rising 3 methods is a bullish continuation pattern. It includes a long bullish candle, followed by 3 small bearish candles contained within the first candle's range, and finally a long bullish candle closing higher, similar to a bull flag. The following 3 methods is a bearish continuation pattern, the inverse of the rising method. A long red candle is followed by 3 small green candles within its range, and then a 5th long red candle confirms the downtrend continuation. We have now covered the major candlestick patterns. The final section focuses on integrating them into a comprehensive trading strategy, emphasizing confirmation, context, and proper risk management. Not all patterns have equal reliability. Very high patterns include engulfing and morning/evening star. High patterns include the 3 soldiers/crows and hammer/shooting star. Always seek higher reliability setups for better odds. Confirmation turns a pattern setup into a signal. You must wait for the subsequent candle to close beyond the pattern's high or low. Strong volume on the confirmation candle validates institutional participation, further increasing reliability. Patterns are most effective when formed at significant price levels. A bullish reversal, like a hammer, at a key support zone creates a high probability long setup. Conversely, a shooting star at a major resistance zone confirms a high probability short. Use multi-timeframe analysis. Start with the higher timeframe to define the trend, and major S/R. Then, look for patterns on the entry timeframe that align with the higher timeframe's direction for optimal entry points. Combine patterns with technical indicators for confluence. Look for bullish patterns when RSI is oversold, or when price rejects a moving average. Patterns at Fibonacci golden pockets offer elite, high-probability setups. Avoid common mistakes such as trading patterns in isolation, ignoring the underlying trend, or skipping confirmation. Remember, patterns on higher timeframes are more reliable, and always manage your risk rigorously. Your trading plan should involve marking S/R and trend on higher timeframes first. Scan for patterns at these key levels, wait for confirmation, manage risk with a strict stop loss, and always journal your trades for continuous improvement. To summarize, candlesticks show market psychology. Context is vital. Wait for confirmation. Use multi-timeframe analysis and indicators for confluence. Remember, no pattern works 100%, but consistency and discipline lead to success.